Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. So today I have with me Brian Anast of Esoterica Investments. For those of you who have been following may remember Brian, who we've had before back in August 2024, where we discussed with Brian and Adam some very interesting options trades they were putting on. Today, we'll be discussing a stock that Brian recently pitched in Omaha at an event my friend Sanjit put together. For those of you who are just tuning in for the first time, Brian has over 20 years in the industry. He's been at Bear Stearns. He's been at JP Morgan, Citigroup. He is a graduate of the University of Illinois at Urbana-Champaign, where I was also at.
Go Illini.
So it's great. Yes, go Fighting Illini. And he also has an MBA from the University of Chicago. Welcome, Brian.
Thank you, Sophocles. Good to be back. Doesn't feel like it was August when we did that last podcast.
You know, I checked because I was thinking, maybe it's too early to invite Brian on. But then I thought the idea is interesting. And I was like, well, with today's attention spans, no one's going to remember what happened last August.
Well, look, I appreciate it. I think today we're here to talk about San Juan Basin Royalty Trust, which trades on New York Stock Exchange's SJT. And I think Adam actually, that's my partner at Esoterica Investments. He initially came upon this idea from a blurb from a podcast. One of the Horizon Kinetics guy was talking about it towards the end of 2024. And we did some research and we liked it. And so, look, what San Juan Basin Royalty Trust is a trust that has a 75% net royalty interest in certain oil and gas producing assets in New Mexico, the San Juan Basin. The operator of those assets is a company called Hilcorp, which is one of the largest private independent oil and gas E&P company. That trust just basically gets all of the revenue, net revenue, from the well and pays out, 75% of that, and pays out whatever they have in there minus some small administrative expenses to the unit holders. So, I can go through, you tell me what's best. Like I can go through kind of the production,
Sure.
What's happened with the stock. I think the best way to look at it is to look back at what's happened the last few years. And so, back in 2022, this thing paid a robust dividend. Yeah, go ahead.
So Brian, and also if you didn't see, for listeners, please pause. You might want to check my short note. So you can go to fatalpha.substack.com. I do a little intro on the case. It might help you and enhance your listening of this podcast now if you read that. And Horizon Kinetics that Brian mentioned is actually the second largest shareholder. So just a quick note there, Brian. And yes, please go back. And also, if possible, if you can go even further back.
I really just I focused on the last 3 years. And what I noticed was that in 2022, there was a really robust dividend being paid. And as well, natural gas prices were pretty high. So to frame it up for you, in 2022, they were paying $1.66 per unit in dividend. And average natural gas prices for that year were $5.50 an MCF. And the unit price of the stock traded between $6 and $15. Right now, I think yesterday it closed at $6.70. Adam and I bought it back in November of 2024. They had cut the dividend in May of 24, and the stock price kind of bottomed out. But if you looked at 22, it was very robust dividend. good natural gas prices, good price of the underlying unit. 2023, same thing. You had dividends of about $1.11 per unit. Average natural gas prices were, call it 470 an MCF, and the unit price was between $5 and 11. Well, in 2024, the operator Hillcorp decided we're going to put a bunch of money into drilling new wells. So they did 2 new horizontal wells. They did 36 recompletions and workovers, and they put some natural gas compression projects online. And what had been CapEx of like $4 million in 2023 ballooned to $34 million in 2024. Now, the way this trust is structured, all of the production costs have to be recovered by the operator before any money goes to the trust. And the trust, once again, like a REIT, is hardwired to pay out all of its cash to the unit holders, aside from administration expenses. This is also a very small stock. You know, its market cap right now is pushing $300 million, but when we bought it, it was $200 million. It's a retail stock, right? And so people are focused on those dividends. So in May, when Hillcorp came out and said we need to put in all this new CapEx, they had to fund it by shutting off the dividends, and those retail investors dumped the stock. You know, as well, you also had pretty low natural gas prices in 2024. But as of September, you know, the price nadir was $3.22 a unit. We bought it in November 24 at $3.83. You know, it was down from 80% from its peak of $15 in August 2022. So for us, we were looking at this as like, look, natural gas prices, you know, they're a commodity like anything else. They're a mean reverting process. So as it ebbs and flows, as it goes up and down, the stock price is also going to go up and down with it. Dividend got shut off. This thing went down to $3.20. The reserves alone should put a floor on how much this stock is worth. And in addition, this is just a trust. So it doesn't have a whole crew of people that it's got to support. It doesn't have to support all this SGA. It's just got an operator, and it has to pay, you know, the excess production cost, the excess CapEx, and any lifting costs before it gets paid any money. So for us, we were thinking about like an option, like there's a floor, and our view was that floor was about reach when the price was trading at, you know, $3 and change. And from there, looked like there could only be upside. Upside could happen because production went up. Upside could happen because natural gas prices went up. Upside could happen because the economy went up. But really, that floor gave us more of a view of this as being like an option position.
What's the floor here?
So the trust owns a 75% royalty in those gas and oil interests. And so, like, if the price goes so low, like there's, you know, you can ramp production, you can slow down production given what gas prices are, but you know, there is some cost to shutting a well in. But in general, you know, you just see these guys kind of as price takers. But let's say that the natural gas price just bottoms out to, you know, 10 cents an MMBTU or an MCF. Well,
Brian, hold. There's a clicking noise.
Oh, sorry. I'm playing with my headphones. So in the future, if gas prices rise back to a normal level, you know, you still have that option value because you're valuing it not just based on cash flows, but the lowest it can go is the reserves. The reserves have to be worth absolutely nothing. So they have to be completely depleted, or you have to have no hope of ever having those worth anything again for this thing to go below a, you know, a floor price, reserves. And we'd put that at, you know, like, I think at the time it was trading at like $200 million market cap. There's no debt on this thing or anything else. All you have to do is make sure that all the excess production costs are paid back.
So the SJT receives a royalty. The royalty is based on the revenues from natural gas and oil, but of course our focus is on natural gas because
I forgot to say 98% of the revenues come from natural gas here. So for oil, I think you can kind of disregard it for the analysis.
So there's the oil revenue, there's the natural gas revenue, which is 98%. Tax comes off, CapEx comes off, operating expense comes off, and from what's left, they get 75%. And
Mm-hmm.
because capex went up, that went into negative territory, and they had to cut the dividend. Stock goes down, presents an opportunity. Natural gas fluctuates, and so and you're expecting mean reversion, I guess. But so there's a couple of questions that come to mind. Well, the one was about the floor, and San Juan Trust is sort of dependent on the operator in a way. So is there any risks there, or do you think like interests are aligned? And then is there any legal rights over the assets?
The net royalty interest, stays with that property. So like San Juan Trust will always have those rights, even if Hill Corp went bankrupt. And in fact, this property has been sold a number of times. And the net royalty stays in place. You can think of it somewhat like a debt instrument, like these royalty trusts. These royalties are generally used as a financing instrument for somebody to develop a property or buy a property. So that's how kind of I think of it. Do they have any risk to the operator? And I will say this: I was familiar with Hill Corp. Like I said, they're the largest independent oil and gas E&P company. They're considered a first-class operator. They didn't become the largest independent oil and gas E&P company by doing dumb things. And in general, companies don't seem to drill many dry wells anymore. And so Hill Corp gets a revenue stream. They get the extra 25% from the revenue stream coming off this oil and gas well. So you'll think, especially if you believe they're a first-class operator, that they wouldn't put that $34 million in unless they thought they were going to get compensated for fronting all that money. Because look, if they put in $34 million and all the wells go dry, they're out that $34 million. There's no revenue coming in to cover that $34 million. Like they're only getting the excess, and then they have to split it with the trust. So in my view, that was a very, very good signal that this thing was going to end up paying off. Because otherwise, I don't think Hill Corp would have put in that $34 million of capex.
Okay, so if Hill Corp goes whatever, worst case scenario, and Hill Corp goes bankrupt or whatever happens, it doesn't really matter because then whoever's the successor.
Some other company, exactly. The only thing I would say is you do want a good operator. You do want to make sure that these guys are trying to squeeze off, but the incentives are aligned so that even a substandard operator should be incented to do the right thing.
So why now? Why are they putting this money in now?
Well, I mean, I assume. Yeah, I assume that they're bullish natural gas prices. And if you look at gas prices, last year versus this year, if you look out on the forward curve, it's around $4 an MMBTU. And, that's a market difference from where it did trade in, early 24 when they had to shut down the dividend. And I think Hill Corp, has seen booms and busts in gas and oil prices. And so they're used to this sort of thing, and they're always planning for the future. The futures market gives us the best idea of where natural gas is going to trade, in the next 2 years. It doesn't mean it's infallible, but it is where people are willing to bet their own money about what the price is going to be.
What's the correlation between if someone is looking at the futures prices versus what they're actually achieving?
Well, it's weird because there is a basis there. So, if you look at it on average, it looks like it trades at a little bit of a discount, but kind of flat to Henry Hub. But there are times when it traded at a pretty big discount. Like I think last month I looked at their monthly production report and their price came in like $1.25, $1.50 below Hub. So Henry Hub, that's the most liquid gas point. They trade at San Juan Basin, and there is a basis. But, when I go back to 2022, and California gas prices blew out because of, severe weather. It traded at like a $15 premium to Hub. Now that doesn't persist, right? Those problems get worked out, weather goes back to normal, and the price is equalized. So in general, when I do the analysis, I think of this as trading close to hub, or the price they get is close to hub. It will be different from month to month. For me, from my analysis, it looked like it generally trades at a premium in winter, and then kind of the rest of the year it trades at a slight discount.
So is there seasonality into buying the stock as well then?
Look, I think this is more of a short-term play. The only thing that I think is really going to affect it is that dividend. And so, like, I think if you're going through my thesis for the stock, it's prices were really low. CapEx was really high. Production was, called it a baseline. And they had to shut off the dividend. So the stock price, the unit price, tanked. We bought it at pretty close to the nadir. I still think it has a lot of room to go. But if you look at 2025, CapEx has returned to more normal. They're projecting $9 million in CapEx for 2025. Prices are also higher. We believe this thing has a floor because of the reserves. And as well, if you look at the first, call it 3 months of 2025, production has really ramped up. It's 30% higher than it was on average for 2024. And when I do the math, if I use an average production of like 2.6 million MMBTUs a month, and I use gas prices today, I can project out the revenue. And to me, it looks like this thing pays down its excess production costs from that $34 million worth of CapEx in 2024 in, call it 3 to 6 months. When that happens, they'll have free cash flow that they have to distribute to the unit holders. And, when I do that, if I look at other royalties that are trading in the market right now, those have a yield of somewhere around 7%. I recheck them after kind of the tariff market noise, and they still, produce a dividend of around 7%. If I look at the annualized yield on prices, these are stale prices because, I just have those in my head. It's like 570. That's a 20% yield on that price, the net revenue to the trust. And so if I take that and I say, well, what if it traded down? What if it traded up so that the yield on the revenue that was coming to the trust was 7%? You get like a 200% increase on your actual stock price. So you can think about it either way. It's either going to be paying a very robust dividend, or all the retail investors that dumped it back when dividend was cut are going to rush back into the stock, pump up the price to equate to 7% yields of other comparable royalties. That's kind of the pitch in a nutshell.
Yeah, I mean, I actually used that as well. The 28%. I saw that from the you mean the March 24 increase in the volume?
Oh, gotcha. Yeah.
Which came about from this CapEx. So the CapEx is going to lead to even higher production, right? So do you have any idea where production then gets to on an annual basis, do you think, a year from now?
I don't, but I'm using, so what's 2.6 million times 12 equals 2.6 times 12. That's, 312 million MMBTU a year. So if you look at, January of this year, they were pushing 3 million MMBTUs in that month. And in March, they were 2.7 million. So I think 2.6 million a month is pretty conservative. And that's a lot of gas for these guys. And most of the year for 2024, prior to the CapEx being put in and pushing up production, it was like 2 million MMBTU a month. So it's, it's a significant increase.
So the production we know is kind of like fact. It's going to go up, sort of, right?
Well, I mean, look, you are still exposed to natural gas prices. I will caution people there. Like, if natural gas prices dump, this thing's not going to stay at. It's now at 670. It's going to go back down to that between $3 and $4 a unit. But I don't think it can go much lower than that.
The one part the volume is going to go up. The other part is price. And I'm sorry, I'm going to have to ask this question, but what do you think about this whole, oil and gas in the context of, what's going on in the world?
It's probably, I'm a victim of my background. I've been in Houston a long time, and I'm still kind of a fossil fuels guy, even though that's not de rigueur. So I think oil and gas are going to be here for a long time. Definitely, for as long as we're going to hold this investment. I think this investment pays off pretty quickly. Like I said, I think that they reinstitute the dividend within 3 to 5 months. So by the end of this year. And look, I don't think oil and gas is going anywhere by the end of the year. I mean, look, even the Greens out there, I think, will agree that there's a place for natural gas in power production. It's the most efficient we got. It's still pretty clean. I don't think it's going anywhere.
Why then, instead of doing, because the stock is also so dependent on natural gas, why not just go long natural gas?
So I'm assuming when you say go long natural gas, you mean get long natural gas futures. And so what I would say is, like, you got a 1-for-1 gain or loss if the stock, if it goes up or down, and as well if it goes nowhere, you've got no profit. Where this thing, gas prices don't go anywhere, you're still making a profit, or at least you're paying down that excess production cost, and you're going to get to free cash flow. Mm-hmm. With futures, that's not the case. As well, with futures, you don't have any floor that we were talking about that the reserves here provide. So this seems more like, capped downside. Look, obviously it was better at $3.83 versus the current $6.70, but still, you've got a capped downside and you've got kind of unlimited upside. You still do have to, remember that natural gas is a commodity and it's probably a mean reverting process. It's not going to go to the moon. But, I think from here, like 200, 150% upside in, 6 months, it's a pretty good trade.
What about, you mentioned there's a few alternatives now, which trade at, 7, 8, 9%. Are they similar? Are they safer? Are they riskier?
So I haven't looked in depth into all of them, but there are a handful, when I gave my presentation, that I was specifically looking at. And in general, the unique thing here was that it had got hit so hard and it had turned off its dividend. So it's funny you mentioned that, because one of the other things we did after we chose to invest in this, and also did all the analysis on it, is we said, well, shouldn't there be other ones that are out there that look like this? And so we searched for ones that had shut off their dividend and were in a similar, and we couldn't find one. So I think this is pretty unique in that aspect, in that it just got hammered and it became something very interesting to buy. That doesn't mean that some of the other ones aren't good as well, but like I haven't seen the same kind of setup that I've seen with SJT and some of the other ones. A couple other metrics that I think are interesting. So when I look at, as of end of March, excess production cost, the excess production cost went from, nothing back in 2022 to $34 million. The highest it ever got was $30 million, because it was using cash flow to pay that down at the same time that they were expending money to drill. And then it went down to $15 million by the end of March. And when I look at the cash flow to the structure, so not net to the trust, in February I show those wells producing net cash flow of $5 million. And is that January? Yeah, January and February I show $5.5 million and $4.5 million. So like that alone, like if you got back to $5 million, you could easily pay that excess production cost down in 3 months.
So just looking at my own table here of my number crunching here, seems tax is pretty flat at 13% for natural gas, 11% for oil. Is that about right?
Are you showing you're looking at the severance tax?
Yeah.
So look, I think different states have very specific formulas for calculating that severance tax. What's that supposed to do is is compensate the state for removing a natural resource from their sovereignty or their purview or whatever you want to say. I haven't gotten the exact formula, but in general, it seems to track the numbers that you're talking about.
Okay. Yeah, and I only just did, looked at percentage of, revenue. And then we have CapEx, which is, we said we're looking at 9 million for 25.
Yep.
And the rest is then operating expense and property tax. Now that jumped about 10% in 24 versus 23. How should someone think about that? Is that, or how are you modeling that? It was 30.8 million in 24, 27 in 23.
I don't have an answer for you for that.
Okay. No worries. So what would you say is then the worst case scenario? The worst case scenario is that
worst case scenario is
price goes back down.
Well, yeah, I was going to say natural gas prices just tank. Like, I don't know, some alternate energy source can be rolled out very quickly, replacing natural gas. Natural gas price goes to zero. But once again, that's a much longer term event than what we're talking about for the investment horizon here. Right? We're talking about this thing should play out in kind of 6 months at the latest. And once it starts getting fully valued, I think it's probably time to find the next one.
So I guess what you're saying is that once they start paying a dividend again, investors are just going to take whatever that monthly, let's say, distribution is, annualize it, and back out the yield and figure this thing is cheap based on that annualized dividend. And so the stock will then jump.
Yeah, that appears to be what happens with most of these retail products, whether they be, that are dividend focused on dividend paying, like REITs or, any other high dividend stock. Generally, you look at the comps and you say, this is what it should trade at. People buy it up because they want that income.
You mentioned Adam noticed it from Horizon Kinetics.
Yeah, they just put out, so like, I think you can ask Adam, but I think that he heard about it on a podcast where a guy mentioned it as a stock that stopped paying its dividend, price cracked, natural gas prices were low, and he was looking at it as an option. And I think that's all he said. And from there, we just kind of ran with it and actually did the analytics and thought, yeah, this is a pretty good thing. But since then, so that was back in, I guess, September, maybe even earlier, where you heard that podcast. November is when we put the trade on. And recently, some of the people in your Cypress chat sent me Horizon Kinetics' recent missive, and it has probably like a half-page blurb about San Juan Basin Royalty Trust, which I thought was very interesting, and it actually confirmed, for lack of a better word, all the stuff that we're talking about right now. So that's another thing that you could read.
Are they viewing this as a long-term income generator for them, or?
I don't think so. I think they're looking at it the same way as us. They think it's, severely undervalued given where other comparable royalties trade, and had just traded way down due to the CapEx and due to the low natural gas price environment, which has since rebounded. And in my recollection, you'll have to go back and check their text, but the text in their report. But I think that they actually said that this thing could, be paying dividends by June, if I recall the text. But you'll have to check it out. I can send it to you after the podcast.
Okay.
Did you get any people post questions on your comment section of your Substack?
No one actually posted any questions, and
I think it's probably just me and Adam reading. No, obviously it wasn't because the price jumped.
So I'm just quickly checking here to see if anyone messaged me. No, nothing. No one's interested.
All right. Well, look at I think it's a great trade. I think it's a short-term trade, so eventually I have to be replaced. but I would caution people to remember that it's a retail stock, that if you buy it, you got to be bullish natural gas prices or try to hedge it out. In general, Adam and I thought about it, and we weren't going to go out and hedge it with natural gas futures because that's just a widowmaker type position. But we do have tail hedges on our entire position. And, we've talked about that with you before. And so, like during the tariff noise, when the market tanked, our tail hedges paid off, and we used some of that profit to go out and buy SJT, which traded down a little bit. It didn't, get hammered like, maybe some of the retail stocks like Amazon or whatever, but it went down, and we used it to double up that position. And that's exactly what those tail hedges are supposed to do.
So what was the last price you bought at
We
SJT?
bought it all the way up to $5 because we bought it during the tariff noise, right? And so it had already rallied because the other nice thing about this particular investment is, in a lot of stocks that you buy, you're really in the dark except for about 4 times a year, when the quarterlies come out. The rest of the time, you don't get any information. This thing puts out monthly reports, which I find invaluable. So every month when something comes out, I update, my model. And as well, you can see the market reacting. So bought in November, 383, tick, 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 tick. It keeps going up. It had a setback during the tariffs, bought more. And then since then, I think we're kind of full up, especially, we're sharing the idea kind of broadly. I put it in your Cypress chat. I think some of the folks there liked it. And so, although I think it's got a lot of room to run, I think as far as the portion of our portfolio, it's big enough.
So I know you guys also have some debt instruments, some private stuff. Is this a big position of yours?
Yeah, it's one of our top positions. I would say it's right now, it's probably pushing 20% of the portfolio.
Oh, wow.
Yeah. So it's gotten big. Luckily, the portfolios, has been growing with the tail hedges and whatnot, so it keeps it in check. But yeah, it's one of our top positions.
Okay, but then you don't have then a hedge if
just the tail hedges. So that's on the overall equity market. They're put spreads kind of out of the money, and like I said, those paid off during the noise around the tariff concerns, and we used that opportunity to kind of monetize some of that and roll it back into SJT.
Now, this is a little bit off topic of the idea, but it could interest people. Like one person actually read my Substack and sent a message. Well, what about tax? Do I have to file American taxes?
So look, I'm definitely not a tax advisor. I'm certainly not going to advise anybody on tax that doesn't live in the U.S. But these oil and gas investments do have some weird tax nuances, and so I would urge anybody that is interested in that to talk with their tax advisor.
Yeah,
it's just kind of one of those things.
And I actually kind of looked into it a little bit. It seems it's different from the master limited partnerships.
It is. So you don't get a K1, you get a 1099.
Yeah.
But it's it's still weird enough. So that's a great. Well, are you a U.S. citizen or are you?
No.
You're a Cyprus citizen. Okay.
Cyprus citizen. So as a Cyprus citizen or a non-U.S. citizen, all I have to do is, I think, do a W-8, and that's fine. And they don't
tax you.
And they reduce the tax.
Okay.
Yeah, because there's a double tax treaty. But I know that with the MLPs, it's a different situation, and so I've personally stayed away from MLPs because I just can't be bothered with the hassle. There's lots of opportunities elsewhere. So yeah, no, I think if you I don't think I have anything else to say. I mean, I think you've covered a lot of the most important questions. I think
Cool.
if you don't have anything else, we can wrap it up and keep the podcast short this time.
Cool. Thanks
Unless
for having me.
there's something else, or if there's any of the other trust we should be looking at, like that you mentioned. I think there's like one you mentioned, like Sabine at whatever 9% or something, that could also might interest some people.
Yeah, look, I can tell you the ones that I'm using as kind of comps. So it's Permian Basin Royalty Trust, Sabine Royalty Trust, Cross Timbers Royalty Trust, and Mesa Royalty Trust. Um, I haven't done extensive, analysis on those, but yeah, you might want to check those out. But I think as far as like an investment that I could recommend, like SJT is the one.
Yeah, yeah. And I see Sabine here is at like something like 8% now. It's been at around this price since 22 actually. So
Yeah,
that's
Sabine, I
I guess
had it
another.
when I was marking it. It was 9, a little north of 9%, but I'm sure it's rallied since then.
Yeah,
But look,
yeah, yeah.
thanks for having me again. Always fun to be on your podcast. And I think the investment is pretty simple, easy to understand, tractable. I think anybody could go out there and actually pull the monthly reports and create their own model. And hopefully they come up with numbers that are very similar to mine.
Yeah, I think I have to agree with you. I think the monthly releases are just fantastic.
Yeah, they're great.
And if someone is building a model, they have to take those monthly releases into account. And also, if they're looking at the annual reports, there's a specific line which actually kind of threw me off, and then I sort of figured it out that it was you had to go from month to month, because some months you could get a distribution and some months you don't, and it kind of
Yeah,
like looks weird unless you adjust for those things. But um, once you figure that out, it's actually really straightforward.
pretty easy to understand. Yeah, much
To,
easier than like looking at a financial corporation like a bank or anything that's got VIEs or anything else.
oh,
It was much easier to.
100%.
Yeah, good.
Yeah. So if once people listen to this podcast and also see the article that I posted that explains some of this stuff, I think they should get a really good idea of what's going on, and then they can make their very own decision. I'll mention. You're not on Twitter, right? Or we can mention your Twitter handle if you're on there.
I don't have a Twitter. If anybody does want to get a hold of us, they can, message us through our website, which is just www.esoinv.com, or you can reach out to me via email at Brian, so with an I, Brian, at eucinv.com. That's it.
All right. That's very generous of you, Brian.
You got it.
So, thank you once again, and I hope you enjoyed this as much as I have.
Definitely. Thanks so much. Take care.
Thanks. Bye. The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.